Hello everyone, you are watching Saheb Academy. If you like our videos, then please subscribe to our channel and also hit the bell icon for the regular updates, and also follow us on Instagram, Saheb Academy. Now let's go to the video.
Hi everyone, this is the second video of Valuation of Goodwill chapter, and in the previous video we have seen the concept of goodwill and we have seen lots of examples to understand it easily. Yes, so now in this video what we're going to do is, in this video we are going to solve this problem with the average profit method. We are going to calculate the goodwill with the average profit method. But before solving the problem, let's just understand the formula of this method and how this method works. Fine, so let's understand first average profit method. That would be simple average method. Okay, we'll see the weighted average method later. Fine, so let's understand average profit method. Now let's understand the average profit method with the help of this example. Let's say this is you, and let's say you want to purchase this existing business from Karthik. Okay, Karthik is the owner of this business, and this is a very profitable business. In the past it has been making profits. It's 2016 profit, 2017 profit, 2018 profit, and 2019 also profit. Yes, so there is a good chance that if you purchase this business now, right, in this year, then in the coming years, in future years also, you will be making the same profits. But can you say that you will be making the same profits indefinitely for unlimited years? Can you say that? No, you cannot say that. Why? Because the market is so dynamic. Anything can happen in the business environment, right? Anything can happen. There can be new competition, there can be change in the government policy, right? Anything can happen. Your business may be demolished due to some government projects. Anything can happen. So that is why you cannot assume that you will be making profits indefinitely in the future, right? Yes, you can say that your business will be making profits for, let's say, 3 to 4 or 5 years, but not more than 5 years. Why is that? Because there can be new competition, new government policy. Yes, anything can happen in the future. Fine. So you can assume that your business will be in the same position which it has been in the past for only 3 to 4 or 5 years, right? Let's take an example of Snapdeal. For example, Snapdeal, if you go back 5 years, then Snapdeal was doing so good in the e-commerce market, right? But now it is not doing so well, right? It is not doing so well. Now Amazon is doing great in the e-commerce market, and Flipkart, yes. So that is what the future is so uncertain. So you can only assume 3 to 4 or 5 years maximum that your business will be in the same position which it has been in the past. Okay, not more than that, not more than 5 years. Now the big question is, will Karthik sell his existing profitable business to you, which has been earning profits in the past, right? So will he sell his profitable business to you? No, of course not. He will not sell his profitable business to you, because he can earn these profits. He can earn the future profits, right? If he sell this business to you on this date, then he will be missing out on these profits. He will be missing out on these profits which this business will easily earn in coming 3 to 4 years, isn't it? Because it is a profitable business in the past. So there's a good chance that in the future also it will be making same profits. And he has put so much efforts. He has put so much efforts into this business. He has built the reputation of this business. He has got recognition in the market from customers. He has built a good base of customers, right? So you are getting a ready-made business, right? If you purchase this business on 1st April, then you are getting a ready-made business, which is a very good profit-making business, right? If you go on by yourself creating a business now, then it will take you 3 to 4 years to build the same business, right? Same profitable business. So that is why to purchase this business and Karthik to sell you this business, you have to pay him something extra. If the fair value of this business, if the fair value of the net assets of this business is 10 lakh, then you might have to pay 30 lakhs or 40 lakhs. You have to pay premium, you have to pay extra. Why extra? Because Karthik has put so much effort into his business, and you are getting a ready-made business, and you have to compensate Karthik for the future profits which he will be missing out on, right? Because he is selling you his business on 1st April, then he will be missing out these profits. So you have to compensate Karthik for these future profits which he would have been earning if he wouldn't have sold his business on 1st April 2019. Okay, so in this average profit method, what we do is we calculate the future profit. We calculate the average future maintainable profits. It is called FMP, future maintainable profits. Okay, we'll come to that now. So Now you will say, how are we going to calculate future profits? How can we know this business will earn what in 2020? How much profit will it earn in 2021, in 2022? See, we can calculate the future profit. Yes, we can do that with the help of the past profit. On the basis of past profit, what we'll do, we will calculate the future profits. Okay, we will see that practically now in solving the problem. See, what are we going to do is we are going to do some adjustment to the past profit. Okay, because we have to go to future profits, right? Future maintainable profit, how much this business can earn in future. Yes, and that will be for only 3 to 4 or 5 years. Okay, keep that in mind. So as I said, you have to compensate Karthik for these future profits. Fine, so that is the goodwill. That extra payment you have to make to Karthik, that is goodwill. Fine, so what I said, you will take the past profit, you have to do some adjustment. I will tell you what adjustment. Okay, so you have to do some adjustment, and then you have to calculate the average. How do you calculate the average? In the question, if you have been given like 4 years profit, then take the 4 years profit total. Okay, let's say 1 lakh, 1 lakh, 1 lakh, then it will be 4 lakh. So you have to take 4 lakh, just for an example, total profits divided by number of years. There are 4 years, right? So divided by 4, then you will get 1 lakh average profit, isn't it? 1 lakh average profits. 1 lakh, 1 lakh, 1 lakh, it is total 4 lakh, then divided by 4 because number of years is 4. Yes, for example, in this example, okay, not in the problem, in this example, and then you will calculate the goodwill. Easily you will calculate the goodwill. How are you going to calculate the goodwill? That is, you will calculate the goodwill by just multiplying by for how many years this business can earn the same profits. For how many years this business will be in the same position which it has been in the past, and for how many years it will be earning the same profits. And I told you it cannot be more than 5 years, and this figure will be given to you in the question, and it is called number of years purchased. Number of years purchased after purchasing the business, for how many years the same condition of business there will be. Fine, so the average what you have got here, you have got 1 lakh, right? So 1 lakh into, let's say for 3 years the same condition of business will be there in the market, right? So this much profit we can earn. Okay, 1 lakh profit we can earn in the future years, average. Okay, we are talking about average, so average into for how many years? For 3 years. For 3 years this business will be making 1 lakh profits, so it will be 3 lakh. So the goodwill will be 3 lakh. Okay, the goodwill will be 3 lakh. So now you have to compensate 3 lakh extra to Karthik to purchase his business. That is the simple concept. This is the simple funda of average profit method. On the basis of past profits, you calculate the future profits, and then you compensate the owner of the business from whom you are purchasing, right? You have to compensate him. Okay, whatever profits he will be missing out on in the future. Fine, and you are making the payment now only, right, in 2019. So you have to make some adjustment. You have to adjust these past profits for the future, because in the future there can be many things, right? Many things can happen in future, so that is why some adjustment is required. So now we will see the adjustment now in the formulas. Now here are the formulas of average profit method. See, how are we going to calculate the goodwill with average profit method? See, first you have to calculate the average profit. Yes, it is called future maintainable profit. How much profit the business will earn in future. Yes, how much profit we can maintain in future. So that is what we have to calculate. Average, okay, it is average. So to do that, to calculate average profit or future maintainable profit, we take the past profits, right? So we add up all the past profit, total of past year profits, and then number of years, we divided by number of years. Fine, so then we will get average future maintainable profit, or average profit, you can say average profit. Yes, and then to calculate goodwill, what we do, to calculate goodwill, whatever answer we get from this, we take that here. Fine, and then we multiply it by number of years purchased. Number of years purchased means for how many years we can earn the same profit, for how many years this business will be in the condition to earn the same profits which it has been earning in the past. Fine, so that is what we are going to do. Okay, simple, right? So this is the formula of average profit method. Now let's see the adjustment that we need to do. Yes, the adjustment to adjust the past profits for the future. Let's see that. Now here we have the format of adjustment. See, here what you are going to do is, here you are going to adjust the past year profits that are given in the question for the future. You are going to correct, or you are going to repair them. Fine, so you are going to adjust the profits of the past. Now you have to do the adjustment only if it is given in the question. Okay, if it is not given in the question, if they haven't said about anything, then you don't have to do the adjustment. Fine. So how to do the adjustment of the past year profits? How to adjust them for the future? See, it's very simple. What you need to do is, if the tax is given, then you have to add the tax, okay, and then you will deduct the tax at last. But in the BCom level exams, there will be no such adjustment. Okay, tax adjustment they will not give you in the exam, so don't worry. Fine, they will only give mostly abnormal loss, abnormal income, future expenses. That's all. Okay, it will be very simple questions. Fine. So what you have to do is, you have to add the abnormal losses which has happened in the past years. For example, let's try to understand that. For example, let's say in 2015 there was a loss by fire. Let's say 8 lakhs profit has happened in 2015. Okay, but let's say there was 2 lakh loss due to fire. How much? 2 lakh loss due to fire. So now what you have to do, you have to add that loss by fire, 2 lakh, and then you have to correct the profit of 2015 from 8 lakhs to 10 lakh. Fine, but why did I add the loss? Don't we subtract the loss? See, that is because that loss is an abnormal loss and it will not happen in future. Can you say that fire will happen every year and in the future also? No, it will not. So that is why it's an abnormal loss. So you have to add it back to the profit to correct the profit. We are adjusting the profit for future. In future, that loss will not happen. So you have to correct that profit. Simple. You have to adjust the profit for the future. So you have to do opposite here. You have to add the loss. Okay. And then we have got abnormal income. Abnormal income is a non-trading income or any income which we will not get in the future. If you purchase the business now, right? If you purchase the business now, let's try to understand this. If you purchase the business now in 2019, right? Then whatever income that Karthik has earned, let's say he has earned in 2018 a profit of 10 lakh. And out of that 10 lakh, let's say 3 lakh income Karthik got because of some shares he had invested in the past. Okay, because of shares he has got 3 lakh income in 2018 and he has shown that he has got how much profit? He has got 10 lakh profit. But out of that 10 lakh, 3 lakh is an income that is not related to business. You are purchasing his business, so you will be earning profit whatever that is related to business. Yes, trading activities. You will not get an income of those shares, right, in the future. So that is a non-recurring income. This income, shares income, it will not be happening, it will not be generating in the future. So that is why that is an abnormal income. So that abnormal income which Karthik has earned because of some shares he had invested in the past, so that is an abnormal income. For example, let's say in 2019 he had got some lottery, okay, and lottery was of 1 lakh and let's say the profit was 12 lakh. So then you cannot say that you will be getting lottery in the future years also. Of course not, you cannot say that. So that is why that's an abnormal income, right? It's not related with business, right? You are purchasing his business, it is not related with business. So that is why it is an abnormal income. You have to subtract that. Simple. So abnormal income will be subtracted. And then we have future income and future expenses. You understood about abnormal loss and abnormal income, right? We are going to do opposite of this. Okay, opposite. So we are going to do opposite. Loss will be added and income will be subtracted. And then we have got future income and future expenses. Now future income and future expenses means the income and expenses which will be happening in the future. So we are adjusting these profits for the future, right? So you have to add the future income, okay, because it will going to increase the profit of the future, right? And the expenses, it will going to decrease the profit of the future. So that is why you have to subtract the future expenses. Okay, so this is what you have to do. And then you will get future maintainable profit, the profits which the business will earn in future. Okay, then we'll take the average of these profits. Okay, we'll take average of these profits. Simple. First you will do this adjustment and then you are going to add them up and then divide by number of years and then you are going to multiply it by number of years purchased and then you will get the goodwill. Fine. So this is the adjustment you have to do. Simple, right? So now let's solve the problem. Now here is the question. Let's solve this problem. See, X company limited purchased the business of Y on 30/6/2019. The profits earned by Y in the preceding 3 years. Preceding 3 years means like before these 3 years. Okay, before 3 years, the past 3 years. So they have given us the profits of past 3 years. Profits earned by Y in the preceding 3 years ending 31st December were as follows. 2016 profit is given 80,000, 2017 profit is given 90,000, and 2018 profit is 70,000. So these are 3 years past profits, okay, past profit of the last 3 years. Fine. And then they have said, on scrutiny of the account, the following info was revealed. Then they have given us some adjustments. You can see A, B, C, and D, right? So 4 adjustments we have been given. So we'll see that while solving the problem. And then they have said the goodwill of the business is estimated at 2 years purchase of the average profits of the past 3 years. So what are we going to do? We are going to calculate the average profit of these past years. Yes. And then with that average profit, we are going to multiply with the 2 years purchase. Fine, that is into 2 we will do to calculate the goodwill. Okay, now let's solve this problem. So they have said compute the value of goodwill of the business. So let's do that. Fine. So first we have to do the adjustment. Let's do the adjustment first. Now first we have to adjust the past year profit, because in this question we have been given some adjustments here, right? So we have to do those adjustments first. We have to adjust the past profits for the future. Yes. So in this question we have been given 3 years profits. Yes, 2016, 2017, 2018. So we have to take that. Fine. Profit 80,000, 90,000, 70,000. Fine. Okay. And then let's see the first adjustment. The first adjustment says the profit of the year 2017, the profit of the year 2017 included a non-recurring income of 3,000. Now what is non-recurring income? Non-recurring income means this income of 3,000 which has been generated in the 2017, it will not be generated in the future. It will not be generated. It will not recur in the future. So this is what? This is an abnormal income. This is what? This is an abnormal income. So we have to subtract this income. We have to subtract this income. Fine. So abnormal income, AI, abnormal income. This is a non-recurring income. It is an abnormal income. So we have to subtract 3,000 from 2017 profit. Fine. And then the second adjustment we have is the profit of the year 2018 was reduced by 9,000 on account of extraordinary loss due to fire. So now here what is given? Here they have given that in the year of 2018 there was a loss due to fire, and due to that loss the profit was reduced. Profit was reduced in the year of 2018. Yeah, there was a loss due to fire, and due to that the profit of 2018 was reduced by 9,000. But now this loss due to fire, it will not happen. It is non-recurring in nature. This will not happen every year in the future, right? Yes, it is non-recurring in nature. The fire doesn't happen every year. It has happened only in 2018, right? So now what we have to do, we have to adjust the profit of 2018 for the future. So we have to add this loss. This is an abnormal loss. This is what? This is an abnormal loss. This is abnormal loss. So we have to add this loss due to fire, abnormal loss. We have to add this back to the profit of 2018. Fine. So we have to do everything opposite whenever there is an abnormal income or abnormal loss. Okay, loss will be added and income will be subtracted. And then here we have the third adjustment. The properties of the business were not insured, and it is now thought advisable to insure the business in future. The premium is estimated at rupees 2,000 per annum. So now here what they have said, here they are saying that they are going to insure the business in future, and the expense, this is an expense, right? Insuring the business, and the premium is an expense. Insurance premium is an expense. So insurance premium is how much? 2,000 per annum. So this is a future expense. So future expenses reduce the future profits, isn't it? Future expenses, they reduce the future profit. So this insurance premium will be subtracted, and it will be subtracted from all the years. Okay, why all the years? Because this is related to future. So we have to make changes in every year, because later we are going to take an average, right? So that is why we have to subtract future expenses from all the years. Same with the future income also, okay, all the years. But abnormal income and losses only to the specific particular year. But this you have to do with all the years. Fine. So insurance premium will be subtracted by 2,000. They have said, right, premium is estimated at rupees 2,000 per annum. Per annum mean per year, right? So that is what. Fine. And then we have the fourth adjustment, that is to cover the cost of management. An annual charge, what? To cover the cost of management, an annual charge of rupees 10,000 should be made in future every year. Now this is also a cost. It's an expense of management in future, right? This is a future expense. This is a normal expense which will come, which will arise in the future. So this will also be subtracted. This will also be subtracted. The cost of management 10,000 will be subtracted from each and every year. Fine. Okay, simple, right? So this is a future expense and it will be subtracted from each and every year. 10,000, right? So 10,000 will be subtracted from each and every year. Fine. And then after subtracting all this, right, non-recurring income and all these, you get future maintainable profit. You see, 80,000 minus 2,000, how much it is? 80,000 minus 2,000, it is equal to 78,000. 78,000 minus 10,000, it is equal to 68,000. Yes. And then here we have 2017, 90,000 minus 3,000, how much? It is equal to 87,000. And then 87,000 minus 2,000, that is equal to 85,000. 85,000 minus 10,000, that is equal to 75,000. And then here we have 2018, see, 70,000 plus 9,000, that is equal to 79,000 minus 2,000, that is equal to, 79,000 minus 2,000, that is equal to 77,000. And then if you subtract 10,000 from 77,000, then you get 67,000. So with the calculator easily you can subtract this. Okay, then you will get future maintainable profit. Simple, right? So this is how you have to calculate future maintainable profit. Okay, abnormal income will be subtracted and abnormal loss will be added, and then future expenses will be subtracted, and if there is any future income, then that will be added to all the years. Okay, keep that in mind. Future income and future expenses will be added to all the years, added and subtracted. Fine. Okay, so now let's calculate the goodwill. Now to calculate the goodwill, what we have to do, we have to use the formulas, right? See, it's very simple. Average profit formula, we have already seen this. Total profit divided by number of years. So now how many profit we have? We have 3 years profit, right? But we have to take now adjusted profit. We have to take future maintainable profit, the profits of the past years which have been adjusted for the future, right? 68,000, 75,000 and 67,000. So we have to take that, find 68, 75, 67, and then you have to divide it by 3. Why 3? Because 3 profits and 3 years, right? So 2016, 2017, 2018, 3 years are there, right? So 3 years, divide by 3, and then you get 70,000. 2,10,000 divided by 3, that is equal to 70,000. Yes, 3 ones are 3, 3 sevens are 21, right? So 70,000 would be the average profit. Okay, it will be the average profit. Now you have to see for how many years this business will be able to earn the same profit, and they have said that years of purchase will be directly given to you in the question. Okay, you don't have to worry. 2 years purchase, not this past 3 years. Okay, don't confuse. 2 years purchase, years and purchase will be together, so you can easily understand 2 years purchase. So they have said in the question 2 years purchase. So to calculate the goodwill, what is the formula? Average profit, yeah, future maintainable profit, which we have just calculated. Yes, that you have to take over here into number of years purchase. For how many years this profit can be earned. Okay, that is the assumption. So number of years purchase, and this will be always given in the question itself, so you don't have to calculate this, or you don't have to worry about this. Fine. So 70,000 into 2, you get 1,40,000 as the goodwill of this business. Simple, right? So this is what you have to do. It's very simple. The adjustment is also very simple. You just have to understand the adjustment, and then easily you can apply these formulas. Okay, it's very simple. It's not a big deal. Fine. Okay, easy, right? All right.